Ladies and gentlemen, welcome to a new episode of the Fintech Hunting Podcast. We have an incredible guest for you today. He is an industry thought leader, a credit expert, extremely well respected in financial services. Please help me welcome the amazing Mike Darne, Vice President of Marketing at CreditXpert. Mike, welcome to the show.
Wow, what an intro there, Mike. Thank you for that. I appreciate it.
You are welcome. Well, it is great to have you. Before we get started talking all things credit and market conditions and everything like that, tell our listeners who maybe don't know your background, you've got a wonderful story. Tell them kind of how did you get into financial services, and let's start there so people get a chance to know a little bit about you before we jump into all things credit.
Yeah, so interesting story. So I actually started in financial services coming out of college. I was a philosophy major. Planning on going to law school, got an internship at a company called Sallie Mae, which is a student loan company. Yep. Decided I liked the business side of things and scrapped my plans to go to law school. And hey, when you're a philosophy major and a company offers you a job, you take it right away. I had a great opportunity to start my career there, learn a lot about the business, from top to bottom. I then went over and spent a couple of years at Capital One. Bringing them into the diversified financial services space as they became a bank. Jumped over to Marriott for a couple of years and was head of marketing over there, and then back to Capital One for a number of years. And, I've been working with more early stage companies over the past few years, and I love that because I love, being hands-on and being able to grow a business. And so I've been with CreditXpert for about going on a year and a half now. And am just excited to be working with this new management team that was brought in.
Fantastic. Well, you have a wealth of knowledge and expertise, so I can't wait to start kind of diving into that. So let's talk current market conditions first. We're in a rising rate environment. People are concerned about affordability. And as soon as you start looking at affordability, one of the things that always comes up is credit. Talk to me about kind of current market conditions and all of those things we just mentioned.
Yeah, no, I mean, I don't think that I really need to talk to your listeners, much about the current market conditions, because that's the only news that's out there today, really. And it's, gosh, man, it's crazy to see that, a year ago, we were at half of what we are today. And, it's really hitting people, as everyone knows, in the pocketbook, if you will. I saw, a Washington Post report over the weekend. And it was just this graphic that was just super compelling. It was scary and compelling. But, I mean, you look at the cost, of a mortgage, a 30-year mortgage over time. If you're purchasing a $750,000 home, the increase in rates, and I think this is shocking here, Michael, the increase in rates is going to cost someone for a $750,000 home $384,000 more for the life of the loan. And I mean, just trying to even wrap your head around that is kind of challenging. But you're right. There are things that consumers can do that I think oftentimes go, overlooked, right? So when you think about applying for a mortgage, the things that are really considered as that offer is made, it's, your income, it's the debt to income, it's the loan to value. Those are things that really cannot be impacted in the short run, right? Short of, your boss dropping out of the sky and saying, hey, here's a big fat raise. Not much of that is going to be impacted. The other component is interest or credit score. And, that is something that can be impacted in the short run. And, what we know is that while we're not going to claw back all of those, increases because of the interest rate, it is certainly going to help a lot of people if they come to the table with a much better credit position than they perhaps were before.
So let's talk about that, because I think you guys are doing something that's vitally critical to our industry.
Yeah.
People just think of when they talk credit, oh, well, let's just help the people that have really bad credit scores. But now with this rising rate environment, different credit bands impact all of us and what we're paying on a mortgage, what we're paying on a car loan and everything. So you guys have created this incredible index. It's called the Mortgage Credit Potential Index. Tell our listeners about that, and then we can dive in a little bit deeper about those different credit bands.
Yeah, so I'll step back on what we call the MCPI. We'll just call it that because the other is a bit of a mouthful. But when I joined the company last year, one of the things that I did was I started looking at aggregated data that we had, right? And so what we do at CreditXpert is we analyze credit records, mortgage credit records as they are pulled by lenders. We do it in real time, and at that point, we can determine how much that person might be able to increase their score over a period of time, a 30-day period of time. In fact, that's what we report on generally here. And what I expected when I started to look at that data is I expected that there would be a relatively large potential or high potential down in the lower credit bands, because my assumption was that people down there are probably making some, errors, in managing their money that could be easily corrected, and that the opportunity would trail off as you got up into the higher bands. But one of the things that just shocked me was that opportunity to improve the score was uniform across all bands, all the way up and down. And so traditionally how we've been used at CreditXpert, and we've been around for about 20 years, we've analyzed nearly 1 billion of these records over time using our predictive analytics platform. We've traditionally been used down in those bands where people need a little bit of help getting over the hump to qualify for an FHA or a conventional loan, right? And that's great work, and we're super proud of that because we help people get into homes that wouldn't normally be able to do that.
Right.
Over the past year, their conditions have presented themselves where there is a huge amount of opportunity for people that might need a little more powder, if you will, given the rising cost of homes, right? We're looking at 20% year over year increases. So we have an opportunity to get people from a conventional loan to a jumbo, perhaps, if they need some more purchasing power, they need the ability to be able to qualify or participate in, an escalation clause for a home or something like that. But then where the real opportunity lies is in the credit bands where people can benefit from risk-based pricing adjustments on their interest rates. And that's what's most important right now. Because as you pointed out, and as we've talked about, interest rates are rising, people are hurting, affordability is going way down, right? If you think about that $50,000 house that I mentioned before, if you kind of like squint at those numbers a little bit and you look at what that person would be able to afford at a 3% rate versus a 6% rate, they can't afford that $700,000 home. It's probably down in maybe the 6, range if you're looking at an apples to apples. And so being able to better your credit score and lower your APR is just incredibly important for so many people today.
I love how you talk about that. And I think the fascinating thing is the impact at each one of those credit bands, because as an originator right now, as a loan officer, as a broker, and they're trying to help that person get into that $750,000 home, and they're realizing, hey, I probably can't do it. What kind of home can I get them in, and how does credit play and impact that? I think is so vital for the industry to understand. It's not just people who maybe didn't manage their money properly or are making a few financial mistakes. When you jump from one band to the other, let's talk about what kind of impact does that have on the borrower?
Yeah, so I mean, it has a massive impact, right? So we ran some numbers, Michael. We looked at a base home price of $350,000 or $375,000. Assuming that 20% down, that would land them at a $300,000 mortgage. And as you start to tick away at that, right? So let's say you're at a 640. If you're able to improve your score by 80 points, and that's not inconceivable, and we can show that in the data, what you're going to end up doing is you're going to be saving about $143 a month, or translate that to the lifetime of a 30-year loan, nearly $52,000 in savings. And so, like I said, it's not going to claw back all of those increases that we've been impacting. But man, I know a lot of people that would like another $143 in their pocket every month. And, you think about what that affords people, right? It affords them to do other things that they need to do in their life, whether that's saving for college or, being able
paying for gas and driving their kids back and forth to school and all their sporting events and whatever it may be.
Before they even get to college. Exactly. Right. So that $143 will, probably, buy you a week's worth of gas these days. So, but that's important.
It is. It certainly is. So tell me, how do people get the index? How frequently is it published? How are you guys leveraging technology to really pull that index together?
Yeah. So, pick back up with, the story with the index was me, seeing this opportunity to kind of look at things in a different way. And what we decided earlier this year was that we're going to release this data in aggregate on a monthly basis, right? We want lenders to be able to look at the MCPI and look at what's happening on the demand side of the market. So we're going to be releasing this about 3 weeks after the close of each month, right?
Okay.
And so it's almost as real time as we can get, certainly within this industry, there's a lot of survey data that's released, but these are actual inquiries that are coming in. So you're gonna be able to see the demand side. So by 20-point credit band, what volume is coming in? How is that changing month over month, year over year? So that's one aspect of it. The other piece is by each of those credit bands, we're also going to be able to show you the percentage of applicants that could increase their score by 20 points or more. And the way a lender can use that is that, I would encourage them to step back and take a look, especially in the market that we're in right now, at their overall lending strategy. Where are the opportunities out there? How do they become more competitive? Where might they be able to spend more time with applicants that they may not have done over the past couple of years because there was so much application volume coming in, right?
Right.
So as I mentioned, we release this every month. It's comprehensive. It's up and down the spectrum. We have a number of different cuts. And one of the other things that we do, with the data here, Michael, is we contextualize it, right? So the initial MCPI or vision for it was this kind of nerdy index where we've got all the data and there's a lot of it there and everything. Trying to bring this down so it's consumable, right? And so we've broken it down and we've done some further analysis such that those that pick this up can understand the opportunity that's out there. So for example, we are able to say, those that did not initially qualify for an FHA loan, how many of them and what percentage of the total application pool could get to a point where within 30 days they could improve their score enough to qualify. And right now, that number for the past 12 months is about 738,000 or 53%. So half of those people that don't initially qualify could qualify for that. We've got the same for...
That's huge. So, I don't mean to interrupt you, but that is a huge number, especially as lenders are looking at how do I keep driving volume in this fluctuating market. Yeah. That is a significant number in and of itself.
So it's a significant number, but I also want to clarify something here, Michael. That number, and we like to stay pure about this. We believe we have about 40% of the market coming through our pipes every month, right? So you take that 738, and that's 40% of the market. So there's even more opportunity there. We're a representative sample of the market. We've tested that out, so you could extrapolate that out. But think about this, right? So we also break it up into a number of other categories. So same thing, those that don't initially qualify for a conventional mortgage, those that don't initially qualify for a jumbo loan. But the one that we're all most concerned with now, which is those that qualify, but because of risk-based pricing could qualify for a better rate. That number, and again, this is 40% of the market, this is ours, 5.64 million people could move up 20 points or more within a 30-day time frame. And I think that's important to keep in mind here.
Absolutely.
Time frame. We're not talking a big, long, arduous process where you're paying somebody with credit repair, counseling, or something like that. Our predictive analytics platform is highly accurate, and we show applicants exactly what they need to do to reach that target score within a 30-day time frame. So that fits right within that loan origination period, and something can be done, right? It's not a long-term come back in 6 months, we'll see you. It can be done right within that loan origination process.
Fantastic, Mike. You have a wealth of knowledge. You and I could talk for hours. I sure hope we can have more of these discussions because it's such an important piece of the industry that we have to continue to educate the market. If people want to get the report, if they want to find out more about CreditXpert, where do they go? How do they get a hold of you guys to find this incredible insights?
Yeah, so I would go to creditexpert.com and just, for those that don't know, it's CreditXpert.com. So go there. We release the MCPI there, so they can go download it there. We have also added a couple of aspects of our site where you can go and you can say, I'm a home buyer that, is looking to borrow this much, has an initial credit score of this, and we will show them exactly what potential they have based upon those that are like them. So we'll be able to say 75% of them can move up 20, another 50% could move up 40, on and on.
Okay.
So you can get kind of granular about that, but just go to creditexpert.com. We're releasing stuff all the time. Follow us on LinkedIn. We're putting the content out there as well.
Mike, thank you so much for being a guest on this episode of the Fintech Hunting Podcast.
Thanks for having me, Michael.